Well, there, John. We are going to dig in a little bit today because I've been on a lot of calls lately. I know you and I have been talking about it a lot. And sometimes we know the answers to some of the questions and wonders that folks from the audience and other
Hmm.
clients that we serve, they have some holdbacks, they have some hesitation, some barriers, and we know the answers, but sometimes even ourselves, like our emotions sort of get in the way. And sometimes it sort
Isn't
of
that the truth?
it gets in the way. It gets in the way of actually acting on what you know is rational, logical, the right move, and the emotions sort of like talk you out of
Well,
it. So I'm having a great time here working with some clients through the idea of borrowing to invest and really
aha.
trying to find ways and to kind of almost prove, because every client will say to me when we hop on a call, some people talk about the Smith maneuver, for example, especially on that
Hmm.
non-deductible interest that we're paying on our primary residence. And a lot of people are like, yeah, I know about that, but, and then the big fill in the blank is interest rates are high.
Yeah, it's
The
high.
home equity line of credit is 7.2 or 7.7. And actually, we
Yep.
just got a rate decrease
Hmm.
yesterday as of
Hmm.
this recording. So now that 7.2 might be more like a 6.95 for
Yep.
some. 7.7 might be more like, 7.35 or something like that for some, but or 7.45. But either way, it's like they see big rate and immediately they're like, well, this strategy obviously doesn't work. And you and I know rationally
That's tough.
it does work, but it's still hard to overcome that
Well,
thinking and that mindset.
two things. I want to say two things to what you just said because it does seem like it shouldn't work when you think about now we're going to dive into some of the math here today to talk about why it does work and how you can actually go about achieving the goals that you're after. But why people are thinking it doesn't is because when you're seeing a 7.7 interest rate, you're like, how do I make sure I get 7.7 rate on my investment, and then how do I make sure I pay this interest bill? Like there's a lot of logistics in convincing yourself that that's the right move for you, your family, your business. But be it to speak to, so we'll talk about that, but to speak to, this like the logic or the data says do it, and then I can't do it or I don't want to do it. Like there's that two pieces. Like I'm reminded of a conversation that, our Matt, if you've listened for, since the beginning, Matt was on this podcast for the first, 50 episodes or about that. And he had that idea of like, in order to make a really important decision, the two pieces have to align. Like you have to, like the logic has to make sense. And at the time, like I don't know if you remember, he was talking about leaving his teaching job and going all in on his real estate business. And it was like, logic said, financially it made sense for him, right? It was like this, like it works, but emotionally he hadn't been convinced yet, at that time that that was the right move. But when he was presented with those two options, and then he started to think about it, he's like, am I happy every day working this way or working this way? And when he was like, I'm happier here, it was like the trigger for him to go, it makes sense in both ways.
Hmm.
And now he all of a sudden took the leap. Like it's the same has to be true for any like all financial decisions. So when we're talking Smith maneuver, we're talking investment, we're talking real estate investing, you're talking about anything, you have to be able to go, does the numbers make sense? Does the logic make sense? And and am I going to be happy? And you've talked about this being like, can I sleep at night? That's the
Yeah.
thing. Like it's like, can I be happy with that decision? And then can I be happy now? Can I be happy in a year? Can I be happy in 10 years? Like both of those have to line up. And right now it's like, how do we help people? And you're doing this on a regular basis. You're talking about numbers every time you're meeting with people.
Mm-hmm.
Here are the numbers, but you're also talking about helping them make that decision to be the happiness decision, the emotional side of things, and getting over that.
Yeah. And what it really comes down to, I think, is trust. And when I talk about trust, it's not just trusting the
Mm,
individual that you're talking to, it's trusting that what your rational mind is doing is true, like it's actually real. And there are uncertainties that you can't control for. For example, we don't know what interest rates are going to be a year from now. We can speculate. We know what economists think. We also don't know what's going to happen to investment markets, right? Like, so there's uncertainty there. And I think that always leaves a bit of like a cloud of doubt. However, we have so much historical data that's at least suggests to us what you can expect. And even, if there's a downturn, or even if there's a
Right.
this or a that, or whatever it is, that like, it's like, if you know the plan and you trust the plan, then you can help to keep your emotions in check. And, something that has always sort of made sense for us as investors is we've always borrowed to invest in real estate. That's just
Right.
something we know. Even at high interest rates, like, we run the numbers and it's like, there of course is risk. Like, there's always going to be a little bit of risk, but it's like, we know what we're signing up for. But when it comes to the Smith maneuver, for a lot of people, like, there isn't really a way to truly Smith maneuver real estate. And what I mean by that is, like, the typical Smith maneuver is the process of turning your non-deductible interest debt on your primary residence into tax deductible debt. So,
Mhm.
like, the thought, if we think about it at that like aspect, like, I leverage the idea of the Smith maneuver to borrow against my home equity to buy more real estate, but it's not like the process. Like, the process is like, I'm going to take $1 of my money that I was potentially going to put into an investment like the stock market. And
Mhm.
before I do that, I'm going to pay it off on my property to create another $1 of home equity line of credit room. And I'm going to leverage that dollar and then invest it in an unregistered investment. Now, you can't really do that month to month, week to week, year to year when it's real, like real estate, because you don't
Mhm.
have a deal that would allow you to take $1 or $10 or $100. You get a deal, you need this much money, and you just take it. So, what I want to talk today about is like the process of doing something that's more systematic. And I'm actually
Right.
going to challenge, based on the work that we
Whoa.
did here to prepare for this episode, I feel that doing this work to help our listeners get convinced of why the Smith maneuver still is worthwhile, even in high interest rate environments, has convinced me to start doing the actual process and not just saving my home equity line for the next real estate deal. Like, I'm going to put it in place. And by the end of the day, like by the end of this episode, we'll talk about like exactly what I'm going to do. And it's going to keep me accountable to do it. I don't know if you're going to do it. You didn't know I was going to say this on the episode, but
Whoa.
I'm actually going to do it because I did so much digging here to help a client that I was like, what the hell? Why am I not doing this? Like, it's like I'm borrowing for real estate, but I have a lot of
All
like, I
right.
have
Let's
mortgage debt and
let's
I'm
get into it
paying
then, because
on
I
the
want to poke
interest.
holes. I'm going to poke holes at it,
I'd
right?
love
So
it.
my brain. I have to like, you've got the idea. You're like, we're going into this, and then I'm like, well, wait a minute. I'm going to play devil's advocate. So
Yeah.
let's get into it. Let's give me some details and
Yeah, I'm going to start here with like some high level, like, I want to help with logic, but then we want to
yep,
actually like prove it with numbers. Cause like
love it.
people, I love a spreadsheet. You love a spreadsheet. And I'm sure a lot of people listening here, like, it seems like anyone who books a call to have a conversation,
They bring their
they
spreadsheet
all like
along.
spreadsheets too. They do. Everybody says it. So they're like, yeah, I want to like dig in here. So I want to start though, just from a logic perspective. So right as of 2 days ago, when
Okay.
the overnight rate was 5%, we just got a Bank of Canada interest rate decrease, or a cut of 0.25%. So now
Yep.
it's at 4.75. Some banks like RBC, for example, have already announced that they are going to change prime. So remember, prime rate is
Yep.
controlled by the bank, and the actual Bank of Canada controls the overnight rate. So basically, the prime rate we pay has a spread. So like, RBC makes money because they can borrow at a lower rate than we can, and then they lend
Yep.
it to us for a higher rate. That like, makes sense. They have to make money.
That's how they make
So
money.
as of like when I made this spreadsheet a couple days ago, we had the average person had a home equity line of credit that was prime plus 0.5%. Some is prime plus 1%. Some is very, like, there are people that have prime. So if you have prime as your home equity line of credit. Awesome.
Yep.
Good on you. But
Yep.
I'm picking the in between there. Typically it's
Sure.
between prime and prime plus one. So I have it at prime plus 0.5. That was at 7.7%. Already
Yep.
we're in better shape because, yesterday the rate was cut and all the banks
Sure.
are now going to follow suit. But pretend for a second, we're going to live 2 days ago. In that case, we're going to look at why in that world it worked. And then we'll show what happens now that the rate is coming down just to see how much better it gets. But 7.7% interest feels like a lot because a lot of people have lower mortgage rates on their property. Some people have 5% fixed. Some people have 2% fixed from a couple of years ago at the all-time lows. So you're like, I'm trading low interest for high interest. It just logically doesn't make sense. But what you're creating is you are really creating a tax deduction for yourself. So that 7.7% is going to come back to you through a tax deduction. And if you think about it, if you're in the 35% average tax rate range, I'm just kind of picking a number. We're not assuming everyone's in the highest bracket or everyone's in the lowest. We're just picking 35. You're in the 35% tax deduction rate. It's like your home equity line of credit interest rate would be 5%. All right. So you take 35% off of 7.7, and it's like you're paying 5%. Now, John, you're going, but my fixed rate is 4.5, or my fixed rate is 3, or my fixed rate is 2, or whatever.
Right.
The reality is, though, is the arbitrage. So you're saving interest on a tax deduction, but you're also creating an investment. So what you're doing is you're actually helping to arbitrage here. And as long as basically my hurdle rate on my investment is like, as long as the investment's over 5%, I'm going to win. And here's the crazy part. The longer I do this and the more I convert more of my my non-deductible interest into deductible interest, as that balance gets bigger, that home equity line of credit has a bigger and bigger balance, and your house balance goes down and down.
Right.
What you end up getting is a bigger and bigger tax deduction each and every year, which can have a significant impact on the amount of money you keep in your pocket, while also building an investment such as an index fund, S&P 500. Paul, one of my co-coaches, was wondering, what is SMP on a recent episode? It's the S.
He's listening to you say it like that. That's why he's like SMP.
S&P 500, the 500 top companies in the US. And we're just trying to be super conservative here. You are going to be net ahead, and we're going to dig into some of the actual numbers here.
So I think one of the holdups that we had initially, and you specifically, because you locked in your last mortgage, all-time lows. So you were like, you're looking at a really low interest rate, then you're comparing it to 7.7, and you're saying, why would I want to trade debt at whatever the low interest rate? Like, think of the lowest mortgage interest rate you can get, and the highest line of credit rate we've seen. So it's like, why would I want to trade that? Because it's like, I'm just swapping debt to pay more interest. And I think the reason, like, we were saying that, but what we were doing is, at the time, and correct me if I'm wrong here on your thinking, is if we're just trading the debt and going, I'm going to swap it to create available capital, then that doesn't make sense right now to me, right? Like, because all I'm doing is now I'm going to pay more interest, which does create, like, it doesn't actually create, in that case, like, when you go, I'm going to pay off my mortgage, I'm going to take the dollar that I was going to put over in the S&P 500, and I'm going to put it down here, and then I create this capital window, or this capital pot of money. If I don't take that dollar now and go over there, then I don't create the tax benefit for myself. And then you're saying, like, I'm just trading debt instead of going, like, I'm going to use it to generate money in the arbitrage. Like, that makes sense, because now you've created this tax relief in a way. Like, you're going to get a tax credit at the end of the year, because you now have this investment that you have to, you borrowed to make money, You're paying interest on that. That's your tax credit. You get to say, I'm going to reduce the amount of income I have because I have this liability or this expense.
Yeah.
And then and then the arbitrage makes sense because of this investment. So almost like in our original thinking, to compare the two interest rates actually have no effect in
Right.
this scenario, right? Like it doesn't even matter what interest rate your actual mortgage is compared to what your line of credit is for this to make sense.
100%. Now, I mean, if forever, so for example, I'm in a really interesting scenario, and like I said, I'm going to take on this challenge and do it anyway, even though in the very immediate term, I'm going to pay slightly more interest and it's not going to
Yeah.
give me the immediate benefit because again, it's
No.
like your investment will need time to compound, to build and grow. And I'm paying like a super low rate. Like my fixed rate on my home mortgage is like 1.84%. All right.
Nice.
Now it's crazy. It's insane. Like, and I'm like, wow, that's awesome. So I've had it and I've had no real urgency to, as you can imagine, like pay it off. Like I'm like, no,
Right.
I have enough capital. I have enough home equity line of credit room. I have other asset. Like I'm good on that front. So I've just been letting it go. But here's the thing that really occurred to me as I was running this scenario for a client. We're not going to run it at 1.84, by the way. We're going to go with like more. A lot of people are telling me they're in the 4% range on their mortgages, people who have renewed and, all of those things. So we'll compare to 4%. But here is what I realized for myself is that my 5-year fixed mortgage is coming due next year. And the reality is in 1 year, if I'm doing the true Smith maneuver and I'm not just taking a boatload of money and paying off a boatload all at once, if I'm taking little bits at a time
Right.
and I'm dollar cost averaging into the S&P,
Sure.
my amount of interest that I pay on that small amount in the first few years is so low that it's negligible, right? So it's like, it's
Uh,
not like I'm trading in a big
well,
balance for a much larger interest rate. It's like I'm
right.
slowly doing it. And then I'm going to have to renew at whatever the rates are at
Right.
next year anyway, which aren't going to be as high as they were this year, but I don't anticipate they'll be anywhere near where it was then. And then I'm going to go, crap, why didn't I get this started so that more of the money that I owed on my home is now on this line of credit that is tax deductible, and noting that your home equity line of credit is variable. So as rates come down, that number's going to get better and better. Like it already
Yeah.
got better in 2 days. Now I
Right.
know it's not going to always be
Well,
like
yeah.
that,
You're not
but
counting on that, right? Like
we're not
that's where your
counting on it.
numbers.
And that's
But
why we're going to keep the number where it was, because no one anticipates that rates are going to go higher than where they were at the 5% overnight rate. Could it
right.
happen? Of course, but it's very, very rare that they start to do cuts and then they do a U-turn and then start, raising rates
Yeah.
again. It's likely that we're going to see some cuts and then some holds and some cuts and so forth to get
Sure.
closer to that 3% overnight rate
Right.
is what economists believe.
Yeah. Now here's the thing that I think some people will get hung up, like me, gets hung up on the details, like what does it
Yeah.
look like? And when you say I'm gonna take this dollar. So let's say first, in order for me to do this, I have to have, this extra money that I'm going to put in, say, my investment. So I'm looking to pad for my future. I'm looking to try to do this, and maybe I'm putting it in I'm putting it in an unregistered account. Like that's why we're saying we're going to switch to do this method. So you not only have to have this, like, let's say it's like a pot of money, part of your budget that you're putting over here
Mm-hmm.
to generate your future investment. So you not only have to have that, you're going to take that, you're going to put it onto your mortgage instead, if your mortgage allows it. So you have to look at those details. That's going to create the opening. You're going to take that, you're going to borrow it and put it over here. So now not only do you have to account budget wise for the original investment, but you now have to account like budget wise for the interest portion.
Mm-hmm.
You have to make the cash flow work for yourself, right?
Totally.
So you can't just say
100%.
I'm going to do this. If I got 12 grand every year, I want to put towards this. I'm going to put $1,000 every month into this. It's going to create $1,000 a room. I'm going to borrow the $1,000 and then have no plan to pay the interest that you're now going to accumulate over the course of that year. Like at the end of that year, you're going to have a $12,000 addition into your line of credit that you now have to account for the interest portion of that all along, because the bank's going
Yep.
to say, give me the interest every month.
Yep.
So So you have to be able to budget for that as well, right? So that you can't just say it's hey, I'm just going to all of a sudden do this and it's going to work. You have to go, okay, maybe 12 makes sense. Maybe I hold back 1,000 throughout the year every time. But then what you said is if you do this year to year 10, this looks very much different than
Oh, totally.
year one.
Yeah, absolutely. And there's different strategies you can have. And I think that's what we're trying to accomplish in this episode is sort of like look at the nuances, because in the first episode, we talked about it at a general level, like
Right.
the idea of like, everyone's like, oh, tax deduction, I like it. Sure. But there's different ways that you can approach it. And I would argue too, that by year 5 or year 10, emotionally, you might be in a different spot. And knowing that there's different options is totally up to you how you want to play it. I'm going to pause there because, yeah, we've got to move over. So why don't we pause it there and we put a pin in
It's a
this.
good idea.
And then basically what I think I
It's a
was
good
about to
transition.
talk about is I was going to talk about how, so essentially what I want to write down here, where are we? I'm
I
going to
have
write it down just here, just to keep it. But John talked about um, accounting for interest in your budget. Kyle was about to talk about
the spreadsheet. Is that where you're going to go? Like the
well,
details?
very shortly, but I was just going to say budgeting interest 12K John said as an example. So you'll need, about
Right.
$1,000 for interest. And John mentioned it might not seem good now. So Kyle will talk about how that could easily get people to not act due to the short term pain they might feel. But basically, like my thought is like, yeah, taking it from there, but then talking about the idea that, hey, listen, if you're not investing anything right now per month, shame on you, right? So it's like we're
Okay.
talking about whatever you're investing now, you're going to just do it in a different sequence. If it's $100 a month, if it's $1,000 a month, it doesn't matter. The thousand's going to go over here, like you said. In the short term, we've got to deal with the interest, but in the long term, you have options on how you deal with the interest.
Makes sense.
And we can talk about this idea of like, once the investment account is large enough, you might take some off the top to knock down some of the line of credit, right? Like you can do that if you want, if that makes you feel better and it keeps the interest down. However, if you stick to it and you just are wise with your budget, the reality is you're getting a refund from the government. So you could take that and put it on the line of credit. Like you can, you know what I mean? So we'll talk about some of those things.
Right. True. That's true.
All right.
Okay. Let's jump over to the link in the calendar and I'll see you over there. I put the notes for the meeting in Slack.
Okay.
And really the only the kind of the prompt that I was like, if we need to, we're going to chat about like, what does the end of the year look like for different districts? Like, what are you doing to wrap? What are you doing to plan already for next year? Like hoping get some people to say like they're doing some key result planning for next year and some of that kind of stuff. So I don't even know who will show up too, because some of these people are like the year's over. Right. So we've got like, there's a couple that we don't have plans to see them until August because like summer's already started. Okay, I will see you there.
So, John, you talk about a really important part, which is budgeting for the interest that you're going to be dealing with, especially initially. Because remember, what we're trying to do is we're trying to essentially convert non-deductible interest into deductible interest, which means there's going to be a delay for when you get this sort of payoff, right? Because you have to file your taxes next year and claim that deduction, right? So I could be, let's say I put in $1,000 extra into my mortgage and then I take $1,000 and I invest it. Well, now I have $1,000 I need to pay interest on for the rest of my year, or really until I choose to pay down this debt, if ever. So by the end of a year, you might have, let's say, $12,000. Well, I have to pay the interest on that which, as we know, that interest rate on a home equity line of credit right now is going to be a little higher. We talked about prime plus 0.5 or prime plus 1. And that money has to come from somewhere. Now, of course, you could borrow from your line of credit to pay off the interest, but I would argue just
That's
budgeting
going to
for
compound.
that.
That's going to compound.
Exactly. Like, don't let it compound. I mean, we could run it and show you that, you're probably still going to be net ahead anyway, but I think it's going to eat into some of the benefit. So rather, if I have, if I'm planning to take $12,000 over a full year, maybe it's monthly, maybe it's weekly, maybe it's whatever you choose, but that 12,000 got to consider the fact that, hey, if interest is 7.7% on a home equity line of credit, then I'm going to be paying, we'll call it an extra 900-ish dollars. Let's call it $1,000 to be safe. So you want to budget in your mind that it will be $1,300 or $13,000 over that year, right? So does that make sense? Was I clear on that, or is there anything I missed on that there, John?
No, I think I like that. So you just have to account for that in your in your planning, right? Like if you're going to, and this is the point I was making, was that you just don't think that I'm gonna like take this and put it here and it's gonna work out. Even Steven, we do need to count for that interest you're going to pay. But I like that you threw in there about the delay, because it's like you have to pay the interest up front, but then trust that the calculations, the analysis that you did on the arbitrage or the interest rate change between what your growth is on, let's say, putting it into the S&P after the fact, and what you're paying, that 5, like we said, break even was 5. As long as you're making over 5, you're making a profit. So if it's like, because if I'm paying 7.7 and I'm making 9, there's that difference, but then you're saving on the tax, right? So the tax delay says, look, I'm going to put all this, I'm going to pay this tax, I'm going to pay the interest now. At the end of the year, I'm going to file my taxes. I'm going to show that I paid interest on this investment. This tax money is going to come back in the form of dollars, and that's supposed to help offset, this tax you paid up front, or the tax you paid on, or the interest you paid up front. And now you can go, I'm just going to dump that back down on the loan. Like take that tax return, put it on the loan, and it's going to start to feel a little bit better in that case.
Yeah.
But it's going to be hard for you, like Kyle, you know that I like, and we talk all the time about clean data. It just doesn't feel clean. When you start to do some of the comparisons and having to wait, and then like this money's this, and it's not always perfect, but there's no clean data coming out of here saying exactly what percentage you made that year. Maybe you can get real detailed, but I know you won't. But the idea is that it will offset, and then because you're going to continue this process, year to year to year, because your 9% on average is a 20-year average on the S&P. It's not like, you got to trust that you're doing this for the long run, and it will work, but you gotta kind of plan for it.
100%. And, I love in our analysis we're about to dig into here. We're not going to really tell you or show you what you did with, say, the tax refund. You get to decide what to do, but I loved your ideas there. And, for some people, it's like, hey, take the refund and invest that too, or take the refund, roll it into the home equity line of credit, and then pull more. Like, you get to decide those things, but we want to look at this at a high level anyway. And I just want you, at least in the first few years, to kind of recognize that you want to budget in that additional cash flow cost to yourself, right? So if you were doing $12,000 into investments anyway, now maybe you want to do 11,000, into investments, meaning you're going to go 11,000 into the HELOC, and then borrow the 11, put that into the investment, because now the
unless you get a
extra
raise,
1,000 is there. Exactly. Right.
Unless you plan for more income.
Decide, but really what I think, for anyone who is investing, if you have a mortgage and you're investing, then you're going to see here that this is really a no-brainer. And the other thing you have to be okay with as well, which I think is hard emotionally, is that, hey, let's say you start this process right after listening to this episode. You're like, you know what? I'm convinced. I want to do this. I'm doing it. And you start doing it. So you put the first 1,000 in, you borrow it, you throw it in the S&P. You do this, let's say, for the whole year, and then the market tanks, right? Like, what do we
Right.
want to do? What do we want to do emotionally? We want to pull everything out. And then, again, so make sure whatever it is that you're doing this strategy with, that you're comfortable for a longer period of time. Your mortgage is a long period. Your mortgage was supposed to be 25 years, maybe, or maybe there's 11 years left, or whatever you're at in your mortgage journey. It's a longer term idea. So think about this investment fund. I would ultimately open up a brand new account, and it's sort of like your set and forget sort of Smith maneuver account. So we're going to assume that you're going to go into an index. For us, we like the US equities over, say, Canadian equities or other countries. So we would do an S&P 500, Paul, so that you will be able to get that pretty consistent growth. Consistent's wrong, but over the long term, a nice return, because it's going to be up and down. And right now we are at highs, and you can wait and say, you know what, maybe the market's going to rip down, but maybe it won't. And you just want to slowly dollar cost average. So this kind of forces you into a dollar cost average situation. So what I want to share with you, John, is I ran a scenario, and this is up on the screen for those who are watching on YouTube. If you're not, go check out Canadian Wealth Secrets on YouTube, hit the subscribe button, and follow along with us here. But we're going to look at a home, and we're going to just pick some nice, easy numbers. The home is worth $500,000. And the mortgage on this home is $300,000. All right. We just picked two numbers. We're going to work from that, but you're going to see similar results. We are amortizing this over 25 years. So of course it's going to be a little different if you're, only have 10 years left on your mortgage. It's going to be even more helpful for you if you, let's say, have 29 years left and you did a 30 years amortized mortgage. But this will give you a good perspective. And what we've done is we're taking this home, we're showing in the left, like in this column C here, this is showing the home, and then we're assuming a growth rate of about 2% on the value of the home.
Yeah, like an appreciation. Yeah.
An appreciation rate, 2%. Again, we don't know what that's going to be. That's fairly conservative over the longer term, especially in Canada, and particularly in some of the spots like the GTA. But what we're going to do is we're going to use this to try to figure out, like, how much better off when we just consider your home, or when we just consider the Smith maneuver with your home. So we're not thinking about any other assets you have. And you'll notice that the mortgage balance after paying down just a typical 25-year mortgage is listed here in column D. So you see that slow decline over time. And what we're going to do is we're going to play here the game of adding $1,000 each month in additional principal payments to this particular mortgage payment.
Okay, got it.
Get our Smith maneuver going. Now, John, you're the mortgage guy. What kind of mortgage do people need to have in order for this to actually make sense for the Smith maneuver? Because, hey, if I have a traditional mortgage and I throw my $1,000 in, and you wait on the other side and you're like, where's the $1,000? You don't have a readvanceable mortgage in order to get that new balance that you're going to require.
Well, you need the readvanceable mortgage, with your home equity line of credit. But, one of the things to consider is looking at how flexible your payment options are. Like, are you having the anniversary double up payment, double up payments allowed? Are you allowed to have, your anniversary 10% or 20% deposits? Like, you want to check some of those features that when you're choosing a product, choose carefully that allow for you to pay off your mortgage in faster rates, so that you can use the Smith maneuver. Because if you don't choose one of those products, then you're kind of out of luck. You're out of luck, being like they're locking you in to get their interest the way that they set up the interest, and you're not, say, being able to double up a payment to get that extra $1,000 in there, or maybe you're waiting to the end of the year on the anniversary date, or up to the anniversary date, you're putting your 12 grand down because it's less than 10% of the purchase price or the mortgage amount. So make sure you've got some of those details in place before you think that you're going to be able to do this.
So yeah, flexibility is key. I'm glad you mentioned about the prepayment because, hey, if I have a readvanceable mortgage, but there's 0% prepayment that I can do each year, which I think is fairly uncommon nowadays, but it can still happen. You typically see 10 or 20% prepayment options on the balance per year typically, but just make sure because, depending how much or how aggressively you want to pay down and how big your mortgage balance is, you're going to want to know those things and make sure it's set up appropriately. So over here, mine is set up to make much larger payments than what I'm doing in this scenario. So I'm good. I'm in the clear. And I'm going to start putting this $1,000 in. And what we did is we took the amortization table, the original, and what we did is we actually added this extra $1,000 prepayment each month towards the balance. Now, some people might be familiar with doing that without the Smith maneuver, just saying, hey, I just want to aggressively pay down my mortgage. And you'll notice, just like you might suspect, like with this particular payment, I think it was about $1,500 a month on this particular mortgage. And by adding that extra $1,000 per month, you'll notice, and if you did it consistently from the start to the end, it will be done in less than 13 years instead of 25 years. So that's a good thing, right? You're like, well, that's amazing. Now, remember, though, we're going to apply the Smith maneuver, which means we're actually going to create you new debt. So you're not necessarily debt free, but let's look at the actual impact because what's going to happen each year. So you can imagine your line of credit is going up by $12,000 a year. We're assuming here that we're not compounding the interest, meaning the typical home equity line of credits requires you to pay interest only every month. So we're going to make that payment. You get to decide where it's coming from. It comes from that budget as we discussed.
We talked about that. Yeah, we talked about that. So we're good there.
So over here, I'm using 7.7% for a home equity line of credit interest rate. That is reasonable for prime plus 0.5 in our 7.2 prime rate environment. We're now going to, as we mentioned, 6.95 for most big banks. So that number is actually going to come down for a lot of people, but we're going to run the numbers as they were just a few days ago. And I'm going to assume you're in a tax bracket of, say, 35%, or at least your top end of your salary is in 35%. Of course, if you're 40, if you're 53%, if you're in these higher brackets, and obviously you're getting a bigger benefit. If you're in lower brackets, you're going to get a lower benefit. But just with that deduction, I want you to look over here at the real interest cost. So 7.7% is really a 5.01% cost for this person in the 35% tax bracket, simply because of the tax deduction.
Yeah. Like, let's make that clear, right? Like, let's make that clear to our listener here, is to say, like, I'm paying 7.7% in interest now, but remember we talked about that, come tax time, which is going to be, you're going to claim that you've paid out, in this case, in this is by year, right, Kyle? So we've got in year one, let's say in year one, you've paid, after year one, you've paid $1,800 in interest on that line of credit, which you now get to claim as an expense for your investment. And that's going to give you back $647 in rebate.
Yes.
At the end of the next year, if you think about it that way, right? So now it's like, okay, that's a good chunk of money. And that's where, when you think about that, so then the 647 is really that savings. So when you think of the difference, that's the amount of actual interest you paid. And that accounts for about 5%.
Exactly. So when you look at that, you go, okay, like that doesn't feel as bad. And that's why we wanted to really make sure that that is clear for everyone, that, hey, listen, high interest rate doesn't look good. Now, mind you, on this particular mortgage, I forgot to mention this, but the mortgage rate we picked for the original mortgage, the traditional mortgage amount, was 4%. So again, adjust up, adjust down. You're going to, obviously have some differences here, but we picked 4% just because it's kind of in the middle of where people may have been, landing in the fixed environment over the past couple of years. And basically what we're looking at, of course, there's, 7.7 doesn't look as good as 4. And even after the tax, 5% doesn't look as good as 4. However, remember, the intent of building this line of credit, right, balance, is so that we can create investable income. We're not taking 12,000 and just leaving it there. We're taking that 12,000. We're not going to spend it. We're going to actually buy an investment. And of course, dollar cost averaging into an index fund is one of the easiest ways. It's also one of the most liquid ways too. So this is the other thing, is that, hey, listen, if something changes in your life down the road, you have access because it's in the public markets. You're not locked in for a time or anything like that. You have access to it. So what we're going to do, and again, we're not going to tell you what to do with the tax deduction. I mean, there's some obvious things. You can reinvest it. You can use it to pay down more home equity line of credit, whatever you want to do, or just pay down interest. That it's totally up to you, or pay down the line of credit balance. So we're not really factoring this number in. We're just saying like what the real interest cost is. So in year one, $600 instead of our, nine something, right? Instead of 924, it's really $1,200 in year two instead of 1850. It's really $1,800. So you're noticing it's like your interest costs are going up, and that can be scary. Your balance of the line of credit's going up. Your real interest cost is going up. But what we also see here is your investment bucket. And this investment bucket, we have it going up at 9%. We'll play with a couple numbers here, but 9% typically on average, if it's an S&P type index, seems like a reasonable amount. We're not going to put 12% like Dave Ramsey would do on mutual funds, because that's not realistic for most mutual funds. But for an index fund that is equity focused, for sure. If you want something more conservative, you can bump that down too. And we'll do that in a few minutes to show you what happens. And what I want to show you here is what your net worth over time would be. And I just want to lock up my rows here for those who are watching. We're going to lock up these, and we're going to lock up these right here. And you're going to see that without the Smith maneuver, you are paying down your mortgage alone. And, your net worth right away, you had $500,000 home. The mortgage amount was 300. So you had a net worth of 200,000. You'll notice as you go down that your net worth increases. You have principal pay down happening, and you have this slow appreciation happening on the properties.
Now, here's something to consider. Did you factor also in, if I was considering the Smith maneuver or not the Smith maneuver, is I actually have this extra $1,000 that either I can use the Smith maneuver and put on the mortgage, or I don't use the Smith maneuver and I just have this $1,000 to completely stick in the S&P right now.
Ooh.
Right. So like, I wonder what that net worth looks like if I had put my $1,000 in the S&P now and did not use the Smith maneuver versus eventually, because I know you're not showing yet what the net worth looks like when using the Smith maneuver.
Yeah.
You're just saying when I'm not using the Smith maneuver, but I did have this $1,000. Otherwise, what are we doing? Right. So it's like, let's look at that scenario and go, okay, well, what do we got here if I just go straight to the S&P? Which is what people are typically doing, right? Like, people are typically going, I have my mortgage payment. I also have my investment funds that I contribute to on a regular basis. Maybe it's RSPs, maybe it's tax-free savings account.
I love it.
Maybe it's unregistered. So let's put my $1,000 in my 9% investment now and see what this comes out to be.
John, I'm so happy you're here, because that didn't cross my mind, but I'm sure it's crossing some other people's minds out there as well. So I just added that column here really quickly. And it's a really good one to look at and to consider. So something that's really important that I'm going to mention, and you're going to notice here that what you've suggested, it's going to take you longer to sort of make this feel like it makes sense or is worthwhile. But what I want people to recognize is that by increasing your taxable tax deductible interest on that line of credit, as your net worth grows, typically your income tends to grow as well. So as let's say get better positions at work and so on and so forth, you're actually going to want to have more deductions later. So you're going to actually want to build up this tax deduction bucket over here. And you're going to see that in just a couple minutes. So right now on the screen, you're seeing the net worth with the additional 12,000 just going straight into the investment, no interest, none of that stuff happening, none of the arbitrage. So you're noticing that, of course, your net worth in year one's 212 now instead of 200 because you're investing the 12. You're noticing it's a little more than 24,000 in year two because, of course, that 12,000 each year is
Made some
compounding.
interest. Yep.
And now when we compare it to the net worth with the Smith maneuver, what you're going to notice is that for the next little bit here, so at first in year one, you're actually behind in both cases, right? Because you're paying interest. Remember that initial interest you're paying is like, I'm actually a little bit behind just paying down my mortgage normally.
Sure.
And I'm much more behind the other investment because that 12,000 is now going straight into the S&P. And you'll notice that in year two, I'm still behind, year three behind, year four, but I'm getting closer. And you're going to notice that by 1, 2, 3, 4, all the way to it looks like at year 8, you're going to see that the net worth with Smith maneuver starts superseding in this particular scenario of the just regular mortgage pay down and the investment straight into the S&P, and you start to see the growth starting to take off. And in this particular case, we're only showing your net worth comparative to when the mortgage is paid off, which is in year 12 to 13. So you're noticing here that you're, compared to just paying off your mortgage, which is 441, your net worth with the Smith maneuver 767. So that's a substantial change. That's about a $300,000 improvement. Now, when you compare it though, just to investing straight into the S&P, you're only about $30,000 higher. But the real benefit now is what happens in these later years. And so I'm glad you shared that because, John, that is a really important piece that if you don't do Smith maneuver, you're still going to have a ballooning net worth, which is great. But the Smith maneuver under these conditions, and again, we picked 4% for the mortgage, we picked 7.7% for the home equity line of credit. Remember, as rates continue to come down, we're at 20-year highs in interest rates. As that number keeps creeping down, these numbers are going to get better and better and better. But what we want to show is that the Smith maneuver still works in a high interest rate environment, assuming all other things are equal. And of course, the lower your fixed mortgage amount is, or the higher the fixed mortgage amount is, that is going to impact your, we'll call it break-even point, your catch-up point. But ultimately, what you're doing is you're taking this process to sort of converting over as much money into tax-deductible interest as possible. So I'm going to pause there and see if there's any thoughts or wonders you have, John, before we show what happens after the home's paid off.
That's what I was going to say. It was like
invest your mortgage amount that you were
right. So that's the nice. You paid off like by putting the extra money down that you were going to put in the investment. You've just shown that after. I think it was year 8, all of a sudden the interest, the net worth was taking over. So you're already gaining extra money in this scenario at year 8. But then if we are paid off in year 13, because we paid it faster in this technique, then if you get to now take your mortgage payment and dump it down on your line of credit. And now you're going to start to pay off that line of credit with this extra payment. And now every one of those, because it's like paying directly to like the principal in a way, right? If you use the same term as your mortgage, you're just paying straight into because you're already paying the interest off with that extra money you've been budgeting for. So now you're going to pay off that line of credit and every payment to that. So every $1,500 payment you're now putting in there is straight $1,500 to your net worth. So, you're already speeding this process up, and then that amount's going to be paid off and you didn't have to contribute anything extra.
I love it. I love it. So now, John, we looked at, the Smith maneuver alone getting to the end of the mortgage. So the mortgage is paid off after 13 years in this particular scenario. We saw that we'll call it the break-even point on when it becomes, helpful with these numbers was around year 8, as opposed to taking that 1,000 and just throwing it straight into the S&P. So again, investing is the key, right? Like investing is the important part here. But if you want to maximize what you get, the benefit you get by doing the Smith maneuver is this mortgage payment was 1583. Think of what happens after year 12 and a half ish when your mortgage is done. You had $1,000 going on to the balance of the mortgage in order to grab that money and reinvest. Here's something we didn't factor in here, that as your mortgage gets paid down, you're actually opening up more balance as well. So you could actually be borrowing more than the $1,000 every month because your principal is opening up more readvanceable line of credit. So we did not factor that in, right? So that's money, that's more investment dollars that you didn't have and that you could repurpose here. We're just going straight up apples to apples with this extra 1,000. But after the mortgage is paid off, instead of taking 1583 and then finding something else in your life to spend it on, take that 1583 and continue investing it into that same investment or some other investment. And if we assume it's the same investment at the same rate without adding any new debt, so you're going to notice the line of credit is at 156 here, and we just keep it as is for now, you're going to notice that your net worth with the Smith maneuver, as opposed to without it, is continuing to balloon. So by year 25, when the mortgage should have been paid off, you're $1.5 million better. And that's without actually utilizing more of the equity in your home. You've only utilized $156,000 worth of it in order to create a real interest cost of $7,800 a year and a tax deduction of $4,200 a year. So if you were to double that number, you can imagine that these numbers are going to about double as well or more, giving compounding. And I want to show you another option. Some people are like, you know what? I just don't like the idea of having a balance. Like I want to pay it off for the feeling. Well, guess what? After the house is paid off, you could then take part of your investment and just pay off the actual line of credit. Now you don't get any tax deductions for it. So if you're in a low income bracket, then that makes sense. You're like, well, I guess I don't really need it anymore. Maybe I'm getting close to retirement. I'm 55 in this particular case. And you'll notice that your investment bucket goes down by the 155-ish that we paid off, or 156.
Here's an interesting thought. I'm going to stop you here for just a sec, but because it's like, we've talked about this idea before, is like, if you pay off this balance, so it's like, it's a mindset thing in a way, because if you carry the balance, like in the other scenario, you had a huge improvement because you're taking the mortgage, you're putting it into the investment. It's going to grow over a good chunk of another years, and you've got an extra 1.5 million in just improvement if you versus not doing it, which is huge, right? It's huge. So that's an important moment. But what you did is you used, like you made this clear, you use the equity to make that happen. And that's avoiding that pitfall of owning an asset and then keeping debt equity in the asset. So like we talked about that on previous episodes too, is like having debt equity doesn't help you create your wealth. So like the fact that you're going to now make a choice to go pay off your line of credit is actually saying, I'm creating debt equity every time I put $1 in there. And just because I want to satisfy my mind. And maybe your life changed. Maybe you can't afford the interest component anymore, which was about $7,000 a year, right? It was like, can I afford that? And the interest difference between, what the actual interest was and the tax rebate, it was about $7,000 a year at its most in this scenario. So it's like in your life, maybe you can't afford that anymore. You have to change things. So it makes sense to maybe pay some of that off. But if you
I'm even going to argue though, John, like it's like if worst came to worst, like the mind is key. I think 100% what you said is what is important for us to recognize, that $7,800, think of what you're gaining by having that real interest cost.
You got 1.5 million in just improvement. That's not the balance. Like that's how much extra you got. And just by keeping the mindset that you were using this equity in your home, which you created more value than the actual equity in the home because you use this technique. Kyle, I know you said at the beginning of the episode that you were going to like challenge yourself. It's like,
Yeah,
you're challenging yourself to do this, aren't you?
I totally am.
Because
Before I
you
tell
don't
you what I'm going to
technically do
do,
this right now.
yeah, exactly. Because I think we had mentioned at the top of the episode, or at least briefly, is that we've been borrowing our home equity to buy real estate, but not in any
Hmm.
sort of systematic way. It's when a deal comes, we
Right.
use it. So in my mind, I'm going, well, I have a balance on my traditional portion and I have a lot of room in my home equity line. I'm like, at minimum, what I should be doing is I should be applying a certain number of dollars per
That's right.
month to do this process, just because it's going to give me an investment that I'm not doing right now. Like, I am not putting 1,000, 5,000, anything into the S&P. I'm not doing that. Like, that is not me right now. But I'm like, why wouldn't I do that when I look at these numbers? And I want to show you one more thing here for those who are watching on YouTube. I give the other scenario and I said, imagine if you kept borrowing the 12,000 every year. So that means your line of credit keeps going up instead of stopping the process, right? So if you just kept the
Okay.
habit
All
of
right.
borrowing $1,000 a month and you were reinvesting the $1,500 that you were going to utilize and so forth, what you end up doing is, sure, your line of credit will get big. And when I'm in year 25, the line of credit has 312,000 owing on it. You're like,
Yep.
oh, I thought I wanted no mortgage by then. But then I look at where my house is at a 2% appreciation rate. My house went from 500,000 to 820,000. Now, in recent times, like, your house would have tripled, it seems like, but we're using conservative numbers. So basically,
Okay.
your line of credit amount is the amount of equity you owned or that you earned through passive appreciation this entire time. You bought for 500,000. Your line of credit's 312, the property's worth 820. It's like the equity that you gained over those 25 years in this illustration is essentially the balance of this mortgage. So it's like, oh, that's not that bad. My real interest cost is about 15,000, which you're like, I don't like that either.
Right.
So it's
Right.
maybe a tax bracket thing for you that you've got to decide. You might have a tax issue later in life. Who knows? But what I can tell you is the investment that I created, that bucket at 9% per year. And again, 9% per year every single year is not going to happen. It's going to be 20% one year. It's going to be minus 10 another year. But on average, that bucket's going to be about 1.6, almost 1.7 million, just the investment bucket. So it's like, I've got $312,000 in debt. And at the drop of a hat, I could take that money out of this investment bucket
Right.
and
Pay it
pay
off.
it off. But mathematically, it doesn't make any sense to do it. And you are, in this particular case, about 1.3. This is without reinvesting the 1,500, I believe. Yeah, we haven't invested the mortgage payment. I should have added that in there as well. Maybe I did. Yes, here it is. I did. I invested I continued borrowing 12. I kept investing
Your
12.
geekness is coming out right now.
Oh my gosh, it's amazing. And then you look at this scenario, like, it's 1.6 million, right? So you could keep going here and you can look at all these scenarios and say, like, there is a massive upside and you're saving tax on your taxable income. So
It,
unless you have a low tax bracket, it's like this, the numbers here are going to be beneficial for
all
you
right. I
later
got
in life.
one more pinprick here to figure out. I know, hey, if you've been listening this whole time, you're like, man, these guys have been talking
Maybe we
about
got
this
to
for a
cut it up
while.
into 2 episodes, John.
These
I don't
guys have been
even know.
talking about this for a while. But here's a pinprick. Is like, okay, you say the investment and the net worth, blah, 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 is worth this much money, which is great. But how much interest did I pay over the course of that 25 years out of my pocket?
Ooh, I love that. You want to see. So
I
let's,
want to see,
do
like,
you want, like, in the
somebody's gonna be
original
like, you know what?
scenario?
But I paid all this interest, and it's like, but that maybe that was $1 million worth of interest.
Yeah, totally, totally. Well, let's look at it. Let's go to, well, I guess if we look at, let's look at the invest the difference scenario, for example. So we just
All
have
right, all right.
that balance of 156. Your real
Mm-hmm.
interest cost, your real
Mm-hmm.
interest cost over
Mm-hmm.
time has
Mm-hmm.
been 156,000, basically. Basically works out to the amount of debt that you have,
Mm-hmm.
156,000. Now, my wonder for you though is now, and we don't have access to this second, but I'm wondering, how much interest did you save by paying off your mortgage in 13 years
Gotta
instead
compare
of
it.
25 years? Like we can go down that rabbit hole and
Man, we could just keep
John, I
going. We could
will.
keep going. You will
I
after we stop
will.
recording here. You will.
But
So
but
here, let's
ultimately, like the big thing for me is I look at it at minimum. I don't know how I'm going to feel emotionally in 10, 20 years. But what I
right.
can say is this, is that if I can, in the meantime, in we'll call it in my earning years where our tax brackets tend to be higher, if I can create and convert more of my mortgage debt into tax deductible debt, growing a pot of money here as like, I'll call it in a way like an emergency fund if something went sideways on,
Right.
on this strategy, right? Who knows what can happen down the road, and pay off my traditional mortgage in 13 years or under 13 years instead of 25 years. And then at that point, have the option to go, I have this bucket of money that I may not have had otherwise. I can now take this bucket and I can use a small percentage of it, as we saw, the paying down the debt and then investing the difference. When I look at that and go, I can still have a nice improvement of even $300,000. Like, so if you're like, I don't want to have debt beyond, sorry, let me look at this one. The improvement would be 1.5 million after 25 years. That's without you, that's with you like paying down, sorry, here it is. 1.3 million is what it is when you pay off the debt after your mortgage has officially
Right.
wrapped up. So I'm going to say that one more time because that was probably a super tongue twister. But if you don't like the idea of debt, it's like get yourself to a place where the mortgage is paid off. You now have a bucket that I can use this bucket to pay down the line of credit if I choose. You don't have to make that commitment to yourself now, but you just know it's an option for yourself. You are now in a better spot. By year 13, you're going to be $374,000 ahead. And by year 25, as long as you leave the bucket after paying off the debt and just let the bucket ride, you're going to be at about 1.2 or $1.3 million ahead. So there's so many different variations. And of course, keeping as much capital coming towards that investment over time instead of repurposing the mortgage payment that you no longer have or whatever it might be, you can keep that cash flow going into the investments. It's like I just think about how it can accelerate your mindset around your
Mm-hmm.
progress. When people are thinking like, I just don't feel like my investments are growing hard enough or fast enough. It's like when you're able to do something like this, you're essentially supercharging the situation without necessarily bringing, and in the early years, there is that interest cost up front. You're not bringing a whole lot of additional capital to the table. You're just changing your mindset and changing the process to try to
Mm-hmm.
maximize the outcome for you and for, of course, those you care about.
Yeah. The secret sauce here really is being emotionally okay, and remember, convincing yourself logically with the numbers working out. And sometimes not everyone can create a spreadsheet like Kyle has here. This is partly why we created this, is to help you see that the numbers will work out. But part of it is being emotionally okay with going, I know this looks weird when I see this debt and I'm creating more debt, or I'm transferring one debt into another debt with a higher interest rate, but trust the fact that if I'm in it on a long enough horizon, that this arbitrage between the interest will create like, it's almost like, I don't want to say magically, but it is magically, but it's like,
Feels that way.
this is how we create wealth, is you thinking about different strategies and being okay with it, because it makes sense that you all of a sudden have this extra pot of money. This, you've created wealth from really nothing, and really in a sense of just restructuring the way you think and about how your debt looks on paper. And
Yeah.
that's the secret sauce for me, is like thinking about, how do I make myself okay with that, and knowing the numbers is a really great way to do that.
I think, kind of building on your idea, the secret sauce of this idea of good debt and responsible debt. Okay. Because a
Right.
lot of the strategies that we share involve debt. Like real estate purchases typically involves debt, right? And people
Right.
feel a little better about that because people typically, if they own a home, have had that sort of debt. Well, the same is true here. We're going, listen, we're just repurposing the debt to be more efficient. And we're essentially, like releasing that debt equity, or at least some of it. Because again, like I said, this isn't even a strategy to utilize all the debt equity. There, you could go more aggressively if you chose, if you're confident. But the part that I think I want them to take away as a secret sauce here is that understanding what is going on is necessary for you to keep your emotions in check. And why I say that is because, John, you and I, there will be times where we sort of like wake up and we get this feeling like, oh shoot, are we is are we okay? Are we on the right track? And you know what? The only thing that works for me, I can't speak for you or anyone listening, but the only thing that works for me to get the emotions under control is to reconvince myself of why I did it in the first place.
Right.
So for me, it's like you can't blindly go into, say, the Smith maneuver. You can't blindly go into a permanent whole life policy and leverage for investments without being 100% certain that you're going, I get why I'm doing it. I have a plan with maybe multiple options down the road, but I understand the options and I know which option I might take in a different scenario. And then along the journey, this is the part that I want people to really think on, is that you're going to have doubts. And when you do, you need to pause and you need to remind yourself, why did I do it? And it might require talking to someone in your network, talking to us, or going back to whatever it is that you did to convince yourself initially to engage in that process. And I'm telling you, that is the way that you can stick it through, because it's so easy when things aren't going exactly as I'd like for you to go, uh-oh, this is a bad move. So hopefully you took this episode and it gives you some ideas of maybe something you might be able to do. And I'm going to challenge people, as I mentioned to you, John, I'm going to start this process. I'm going to be doing $1,000 a month, and I'm going to use $1,000. And I'm only going to, I have home equity line or like line of credit room right now, but I'm going to do it to just chop down this mortgage and reinvest the difference, because I'm not doing a DCA into the S&P. And this is
Right.
proven to me that I'm like, why not? Like,
Right.
let's do that. So I'm going to do it. And along the way, we'll update folks how things are going. And we'll hopefully hear from some folks who are also going to follow along, whether it's 1,000, 100, or maybe it's something larger each month in how they're going to apply what they've learned here today.
Folks, if this is your first episode, we applaud you for listening to the end of this one of our longer episodes. We encourage you to hit that subscribe button or the follow button. And we put out episodes every Wednesday. Have been doing this for almost 1.5 years or
Oof.
longer. This is episode 81. So, it's around that. If you've listened to a few before, we encourage you to hit the rate and review button. Leave us that rating and review.
Friends, I'm having a blast chatting with all of you Canadian wealth secret seekers on discovery calls. I've had people calling, asking about the Smith maneuvers, some people asking about some of our par whole life strategies. That's, I would say, our secret sauce moves with some of the leveraging techniques that go alongside it. Listen, if you want to hop on a call and share your situation, we'll do our best to try to provide you with your next step forward, especially those business owners. If you are an incorporated business owner or investor, we've got some secret sauce strategies that you should be implementing already, but probably are not. So make sure to reach out over at CanadianWealthSecrets.com/discovery. And I can't wait to chat with you soon.
All right, Canadian Wealth Secret Seekers. We'll see you next time.
Just as a reminder, my friends, the content shared here is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. John Orr is a mortgage agent with Bricks Mortgage, license number M23006803. And Kyle Pierce is a licensed life and accident and sickness insurance agent with the VP and is the VP of Corporate Wealth Management with the PanCorp team. That includes corporate advisors and Pan Financial.